I have found that most investors focus on return on investment. And personally, I think it is the least important of the big three. My name is Rich Lennon. We talk about growing the money. You are in the right place if you are trying to figure out how do I grow that money, get to the spot that I want to be at. You're there. We talk every morning from, well, in the summer, we talk 9 to 9:10. But let's just dive right in. All right, let's go. Let's get it. Return on investment. I find when I talk to investors that whether they're lenders, whether they're real estate investors, whether they're stock market investors, whatever, the investors seem to be overly focused on this idea of return on investment. And I'm not saying it's not important, but I think it's the least important of the big three, and I want to talk about it. All right, return on investment. If I lend you $200,000 at 10% for a year, and you keep it for 6 months, then your return on investment when you get it back is 10%. So I lend you $100,000. It's at a 10% interest rate. Your return on investment, ROI, is 10%, but they only keep it for 6 months so that you only get $5,000 return on that money. And so you go 6 months, you get a 10% return, which is $5,000. But often what happens is real estate investors get caught up with deploying the money, constantly worried about the return on investment of the money and ignoring the number two most important thing, which is yield. So when I make $5,000 on my $100,000 in 6 months, I get a good rate of return of 10%. But if I don't deploy my money for the rest of the year and it just sits in a bank account, it earns 0% interest for the next 6 months. That brings my total yield to 5%. Yield is what is the return on your money over the course of 365 days. And I see a lot of people getting these two confused. And some people chase the return on investment. They hey, I don't want to lend my money out unless I can lend it at 12%. So I'm going to keep it in my bank account and pass over on deals that are 10%. And overall, that really hurts your investment portfolio. What you should be focused on in those situations is what is my return on my money over the course of the year? And that is referred to as yield. And therefore, yield is much more important than return on investment. I need to have a sip of coffee. I got a little frog in my throat. But I think the next one, the third one that is rarely talked about, is the most important of all, and that is the return on wealth. And what I mean by that is you should be keeping up with your wealth at least once a month. I think that that's a good litmus. It's a good habit. It's a good way to make sure that you're continuing to grow. And that is that you should sit down with your spouse and your family and all those that are involved with it. Maybe not your kids at a certain age, but you should sit down at least once a month and you need to calculate what is your wealth and how is your wealth growing. And it's hard to move all your money in wealth all the time. And so that's why it's worth the discussion. Like, for example, if I'm worth $1 million and I go out and I invest $1,000, and even if I earn 200% yield on that money, my $1,000 got a 200% interest, 200% yield that year. So I made $2,000 on my $1,000 investment. That's an amazing investment and it feels awesome. But the problem is it doesn't move your wealth at all. And one of the things that you need to do to gain a fair amount of wealth is you need to focus on what is the return on your wealth. And a lot of obstacles are out there for the return on your wealth. And that is that a significant amount of your wealth doesn't get you a return on investment. The return on that investment is often zero. So, for example, your primary home is not an investment. It is a return on investment of effective zero. Yes, you can have some appreciation that may or may not happen. It depends on where you are on the cycle. But in terms of calculating how to get the return on your wealth, there are a bunch of things that are at 0%. So you need to begin to look over your entire wealth. Figure out, where is your wealth? Is it in equity in real estate? Is it in cash? Is it in notes? Is it in the S&P 500? Is it in Tesla? Is it in NVIDIA? Wherever it is, you need to calculate out where your wealth is and then try to begin to make it so that the yield on all the individual buckets within your wealth are getting the maximum rate of return. And that makes a huge difference in the long term of your wealth. For example, if you have like I in 2020, when I was looking at my portfolio, I realized that 60% of my wealth was in equity, in sitting in real estate property. And then 20% of my wealth was at 0% interest rate. This is my primary home, my cars, my lifestyle, whatever it was, that a significant amount of my wealth was not earning me any return at all. And then I had another 10% in the S&P 500, and then I had another 10% in cash and notes, et cetera, et cetera. So that's 20, 40, 60, 80. Yes. All right. That's 100%. I had to make sure that my math was correct. Okay. So, but what I found when I was balancing my portfolio that way is that my overall return on wealth was around 6 or 7%, which wasn't great. And I was getting myself super excited about my lending business that was earning me 20 and 30% returns on my money, but I realized that it wasn't moving the needle enough on my return on wealth. And so I had to rebalance my portfolio, right? So if I had $1 million and I was earning 6 or 7% return over 10 years, that money was only going to grow to something like $2.8 million. And it wasn't the type of growth that I wanted to have. And that's what made me start thinking about readjusting my portfolio and readjusting the balance of the things that I do. For example, a lot of landlords will think about, when do I cull my portfolio and take the equity? If you have $100,000 sitting in equity over in a home and it's only earning 5 or 6%, that has a huge impact on your return on wealth. And so what I did over the course of a couple years was I changed my portfolio from 60% equity in 60% of it being in equity, 20% being it in my personal life, and then 10% in cash and 10% in the S&P. I started to adjust my portfolio so that my yield on my different buckets would increase. And one of those adjustments was I moved the equity from my rental portfolios over to lending, which made a dramatic impact on what my yield would be over the course of 10 years. I would really encourage you to start having those conversations with your spouse, having those conversations with your friends, and figuring out what is the right balance of your formula so that you can grow your wealth at the fastest rate possible. Your 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 lifestyle won't change during that process. I always have 20% that earns me 0% return. But instead of having 60% of my portfolio earning me 5 or 6%, by decreasing where my wealth was, i.e., I went from 60% of my wealth in equity to 40% of my wealth in equity. I'm still a landlord, I still hold properties, but I was able to then move that money over to something that creates a greater rate of return and is more representative of how I wanted to grow my wealth. So when I balance my portfolio of closer to 40% equity, 20% earning zero equity in real estate, 20% still being in my lifestyle, i.e. my primaries and my cars, et cetera, et cetera. And I moved 40%. I got out of the S&P that was earning like 10%. And then I got rid of some of my equity. I took some of my equity that was earning 6%, moved it over to lending. So then I was able to move it so that my portfolio, that 40% of my portfolio was now earning 20 to 30% returns. And it was it was dramatic difference in what my portfolio looked like in 10 years. I'm going to grow from 1 million to 2.8 million in 10 years to I'm going to go from 1 million to $6 million in 10 years. And so I got a 6x return on my money when I rearrange my portfolio. Return on wealth is something that you need to begin to think about. Track your wealth and then calculate what is the return on my wealth, because you have to use that wealth to leverage yourself and to grow it and get to financial spot that you want to be at. My name is Rich Lennon. You can check out my thoughts at richlennon.com. Download the Smarter Wealth Blueprint, where I talk about how I lend money and how I earn those 20 and 30% returns on my private money lending business. But really sit down and think about, okay, how much am I worth today? How much do I want to be worth in the future? and then begin to calculate what type of return, what type of yield that you need to get every year to get to your goal, and then rearrange your portfolio so that the you can have the returns and you can have the yields to get you to your goal. All right, I'm out. Everybody have a great day.